Welcome back to the Houseman Investing Channel. In today's video, we're going to go over about 49 ETFs I have chosen out that are great picks for 2021. Just a brief overview of what I do on this channel is deploy capital into the market, let it set for a set number of days over a various number of stocks. Then I'll pull out my capital from the market, leaving the gains, in the market. I've started this challenge in June, and I've accumulated over $12,500 worth of free stock or risk-free investments for the long term. We're going to jump right into the video. I appreciate you guys tuning in. There is a link in the description below if you want to get you a Robinhood account, sign up, get some free shares. You can get shares of like Google, Coca-Cola, things of that such. You can liquidate them right away, or you can hold them for the long term, which it'll be risk-free as well if you do hold those shares. Once again, I appreciate you guys tuning in. Like the video if you like the content. If there's anything useful to you or any of the stock tickers that you see, if it's something that you get into and just like the channel for me, I would really appreciate it. As well as, subscribe, ring that bell, follow my journey. I do have 12 brokerages. I trade 7 days a week. I give out stock picks 7 days a week as well. I invest in everything between ETFs to SPACs, IPOs, growth stocks, value stocks, the blue chip stocks, international stocks, precious metal stocks, anything under the investing umbrella, cryptocurrency, all of that, I'm into it. I have well over 500 plus positions now, and well over 500 plus positions on my watch list that I'm going to get into. So I'm going to bring you guys the unique stock picks that you probably won't either hear somewhere else. You won't hear very many people talking about them. And, of course, I'll bring you the stocks that everybody's going to talk about. I mean, those are pretty much no-brainers when it comes to YouTube. But, once again, I appreciate y'all tuning in, and we'll get right into the video. All right, so we're going to jump right into it. First ETF we have is ticker SPGI. This is the S&P Global. As you can see, it was down a little bit last week. On the year, it was beaten down about 30+% during the pandemic. Still finished the year up over 12%. On average, this stock, it's a pretty good growth stock. Usually grows about, 35-40% a year. So it's a pretty good growth stock. It does pay a very small dividend of 0.81%, which isn't much, but it's better than nothing. It has a nice PE ratio. Very, strong analyst buys. They demonstrate a strong margin expansion and things of that nature. Once a benchmark is accepted by capital or commodity market participants, it's pretty difficult to displace. And, as a result, S&P has a strong pricing power in its ratings, index, and subscriptions, and things of that nature. And this, they also been killing EPS. And this is a company out of New York. Of course, exposure to business software. And it's going to, engages in the provision of transparent and independent ratings, benchmarks, analysts, and data to the capital and commodity markets, worldwide. The next ticker we're going to have here is RSP. And this here is S&P 500 equal to weight ETF. As you can see, it had a decent week last week as well. This one here does pay a decent dividend of 1.60%. This one was also beaten down about 30%, of course, because it tracks the S&P 500 during the pandemic. Just like the previous one, finished above 12% on the year. This thing typically grows about 14% a year, so it's a nice little growth with that 1.60% yield. Extremely high P ratio, but to me that just speaks volumes that it's got room to grow, and it's basically tracks the S&P 500, the top 500 companies in the world. Then we got SPYV. This is a value SP 500 value ETF from Spider. This is some play that I already hold long term. I'm up 2.16% in my position. Pays a nice dividend of 2.33%. So it's a nice
Nice little income here for holding this one. Just like the previous one, down about 30% on the year. It did recover, fully. And this one usually, is right along with the S&P 500, about 8 to 9% growth per year, sometimes 10. But you're going to get that nice dividend payout of 2-3-3, nice 2 or 3% return on your investment there. And this chart, just tracks large and mid cap value style securities from the S&P 500. So the most, out of the large and mid cap stocks from the S&P 500, the ones with the most value in them, will be tracked. Then we got ticker DFEB. This is also something I already hold. This is a deep buffer ETF, and these are short term. This one is for February, so of course it IPO'd in February. Of course, it was beaten down right away. It did recover on the year, up 6%. And this is more of a growth play. It doesn't pay a dividend. But basically what it does is buffer losses and cap gains on the S&P shares over a specific, holding period. And this is actively managed as well. Then we got ticker NXTG. This here is a First Trust Index NextG ETF. This is also something I already hold. I'm currently up 6.94% in my position. Just like every other stock that I mentioned on here is probably going to be beaten down, so I'll just start giving y'all the percentage. It's beaten down about 25% during the pandemic. Still finished the year off above 28%. Typically grows about 20% a year, and it also pays, a little bit over a 1% dividend. So nice growth, nice little, source of passive income. And like I said, I'm up 6.94% in my long-term position that I have. And this is a weighted index of global entities related to next generation digital cellular technologies. So pretty much the best digital cellular technology are going to be in this First Trust Fund. Then we got ticker FTAG. This is a First Trust index as well. It's going to track the best global agriculture ETF companies. It was down about 7% during the pandemic. It wasn't affected very much. About 37%. So it was affected a lot. But it did finish the year off a positive 18%. This one's not very old. It IPO'd back in 2016. But it shows steady growth, about 6% a year, with a nice 1.62% dividend. Right now, the PE ratio is super low. It's super undervalued. And it tracks the firms that are engaged with improving agricultural yields. So definitely a nice play and a nice sector to get exposure to. And the reason why I'm giving y'all all these ETFs today, I love ETFs. I have well over 500, single share stocks, but I also do a lot of ETFs. It's just a way for me to hedge my money against, the market. Because ETFs give you a nice diversity between a wide range, based on per sector. Plus, it's going to be super low volatility, and it's not going to fluctuate very much. And most of them do pay a nice dividend. So it's also, passive income like monthly, annually, or quarterly income as well. Next, we got ticker, LEGR, another First Trust Index. This is Innovative Transaction and Processing ETF. This one here was down about 30% during the pandemic. Still finished the year up 19%. And this one's a new IPO as well. Started not too long ago, back in January of 2018. And it grows typically about 5% a year. And does pay a small dividend, a little bit under 1%. So about a 5 to 6% return on your investment with this ETF. And it tracks global entities selected based on their, their exposure to the development or uses of blockchain technology. If you follow the blockchain, you already know what's going to happen to this ETF. Then we got ticker EWU, another decent ETF. This is from iShares. iShares has some great ETFs, and this one is United Kingdom Index Fund. So you want to always try to keep some exposure to the global market or international market, something outside of the U.S. like Europe, Japan, China, Canada, Africa, United Kingdom or whatever. Sometimes it's hard to pick individual companies from these other countries because you may not understand them, or be educated on them like you need to be to really invest in them. You got your Nias and your Alibabas and things of that nature, but for the most part, it's going to be you're not going to be well educated on a lot of these companies without doing extensive research. So the good way to get in is through an ETF. You can go in there and you can look at their top holdings and research the top companies that you actually like. But getting into that ETF is going to be a safe play to be diversified over that market with low fluctuation, low volatility. So the United Kingdom fund was tore up about 40% during the pandemic. In my opinion, I think it's going to still run up about 7% here in 2021. So it's going to be a nice little growth play with a nice dividend of 2.34%. A lot of people go for the higher dividends. I really don't, because the payout is so high that company's share is going to be diluted, or it's going to drizzle down. So my sweet spot is between 2 to 4%. Over the years of investing in dividends, I found that usually that's a good dividend spot. And of course, you want to look for your dividend aristocrats and your dividend kings, and such dividends like that. If you're really only focus on dividends, which I invest in those type of dividends companies as well, but I also invest in a whole broad of dividend companies, just for the payouts and the passive income. And this iShares here is a weighted index of British companies that covers about the top 85% of British companies by market cap. So a nice little play here, exposure to the United Kingdom. Then we got ticker EWG. This here is a iShares Germany index fund. So it's going to be very similar to the United Kingdom fund, but instead it's for Germany. And this one was beaten down about 40% during the pandemic. Still finished the year up 10%. It kind of had a crazy year because of the pandemic. So just because it finished, just because it gained about a total, it lost 30 and gained 10, doesn't mean it's going to do that every year. On average, it only gains about 5% a year. And it does pay a 1.27% dividend yield, which is nice as well. So about 5, 6, 7% return on your investment. And it also has a decent, PE ratio. And this one tracks large and mid cap companies, out of Germany. Then we got ticker FVD. This here is a First Trust value line dividend ETF. So it's going to be very focused on dividends. Of course, it was beaten down during the pandemic, about 30%. I think it'll run up about 1 or 2% here in 2021. Plus, you're going to get a nice dividend yield of 2.28%. So it's going to be about 4 to 5% return on your money. A very low PE ratio of 22.43. And this one here is going to track, dividend paying companies. It excludes companies with market caps that are less than $1 billion. So basically, it's going to track only the top, by market cap, the top companies, that have great dividends. So definitely a great safe play and great diversification into dividends. Then we got ticker RPV. This here is a S&P Pure Value ETF. And as you can see, I have iShares, PowerShares. I do JP Morgan Chase, ARK Invest, a wide variety of different, ETFs or funds from different hedge fund managers. You have a lot of overlaps, but each one of these hedge fund managers has their own real specific strategy onto what, the way that they choose their companies, or how much of the company is of their portfolio, or if it's actively managed and things of that nature. So I like to be diversified in that aspect too, and you kind of, get myself into different hedge funds. You don't have to buy all these plays. You don't have to really buy anything, but I'm just giving you these ETFs so you can take a look at them. If you see one you like, you can kind of do a deep dive into it, and maybe it can be something you can put in your portfolio, to hold a little bit of your money into. So back to it. This is S&P 500 pure value play here. This one was murdered 50% during the pandemic. In 2021, I think it'll grow about 6 to 7%, and it also has a 2% dividend. Very super low PE ratio, so it's super undervalued. Like I said, you're going to see probably about 6 to 7% growth with that 2% dividend yield. And this one, primarily tracks large cap selected U.S. companies. The index covers about 33% of the S&P's market cap, using three factors, to select its dividends, to select its stocks. Sorry. Then we got CQQQ. This here is a Chinese technology ETF. So it's going to track the top technology companies out of China, all in this ETF. This thing was down, about 15% during the pandemic. And of course it boomed because of technology. The way it played out this year, finished up 55% on the year. On average, it grows about 9% a year. So nice steady growth. A very small dividend of 0.46, but, it is something to add to that. PE ratio is not too bad as well. And like I said, it's going to track the most investable Chinese companies, technology company stocks. And Chinese is, they have crazy technology over there. And a lot of those big companies have backing by the government. So, they're kind of like fail-proof until the government, says otherwise. So definitely a great exposure to there. Then we have ticker XLG. And this is a S&P 500 top 50 fund. This one here was also beaten down about 20% during the pandemic. Still finished up 20% in the positive. This one usually grows about 20% on average per year, so it's right on par. So you can do about 20% growth with a 1.25 dividend yield. Pretty good PE ratio as well. Almost $2 billion market cap. And this is going to track the largest 50 largest companies in the U.S. So definitely very dependable ETF there. Then we got ticker RCD, and this is the S&P 500 equal weighted consumer discretionary ETF. This one here was also beaten down during the pandemic about 40%. Still finished the year up 14%, and should grow on average about 10% a year, with a small dividend of 0.78. But when you're getting a 10% return on your investment, I mean, you really can't beat that. And it's a safe return at that. This thing is super undervalued, according to the PE ratio, super low. And this is going to track large U.S. consumer discretionary stocks drawn from the S&P 500. And I like a lot of these ETFs that have to do with the S&P 500, just because those are the top 500 companies. So you can't really lose too much with that. Next we have XLE. This is an energy select sector spider ETF. It was down about 60% during the pandemic. I see this one growing about 31% next year in 2021, as it still has a lot of room to recover. And this is one of my favorite plays because of the growth potential, and it also has a great dividend of 5.14%. Super low PE ratio, so it's super undervalued. And this is going to track the top energy companies, in the S&P 500. And everybody knows energy, is a big hype right now, especially, renewable energy, oil and the things of that nature. It's not over for these guys yet. So definitely something I'm going to get into. Then we got ticker ITOT. And this is the S&P 500 total U.S. stock market ETF from iShares. So this is super diversification right here into the total market. So it tracks the total market. So of course we all know that the market was down about 30% during the pandemic, and it finished at all-time highs, up above 20%. And the total market usually grows, around 18% per year. It does pay a nice dividend of 1.39% with great growth. PE ratio is not too bad. And it's going to track all the common entities of the companies listed on the NASDAQ, So definitely a great play there. Then we got ticker SFYF. This is something I'm already invested in as well. As you can see, last week it did pretty good, up 3.26%. It was down about 40% during the pandemic. Still finished up above 30% on the year. This is a very new IPO. IPO back in May of 2019. I think, realistically, I think it'll grow about 8% a year. It's super undervalued at the moment. Very low dividend payout of 0.39%. and it's going to track 50 U.S. listed stocks, mostly widely held in self-directed brokerage accounts, of SoFi Securities based on the highest weighted average value. Then we got ticker KIE. This is a SPDR ETF, and this is in the insurance sector of the market. So get you some exposure to another part of the market, similar like companies like Lemonade, Aflac, things of that nature. This one here was beaten down about 40% during the pandemic. I think it'll grow about 4 to 5% in 2021, and you'll get that nice dividend payout of 1.81%. Great PE ratio. It's right on target, and this is going to track, like I said, the best insurance companies out of the SPDR fund. Then we got ticker HDMV. This here is another First Trust ETF. It's a managed volatility developed international ETF. Down about 30% during the pandemic. I see about an 8% growth in this one for 2021. Decent little dividend of 1.43%. Great PE ratio at the moment. And this is a active fund as well, with low expected volatility, mid cap and large cap stocks, from developed markets. Then we got ticker HDIV. This one here is a Craft AI enhanced U.S. dividend. It was up. Had a pretty good week last week. This one's fairly new as well. Just came out February 2020. Down about 25% on the during the pandemic. Finished the year up 14%. I see this one probably growing. Probably about 2 to maybe 3% a year. Decent dividend of 2.16%. Decent PE ratio as well. And this, like I said, this is an actively managed portfolio that's going to track, high dividend paying U.S. companies, chosen in the realm of artificial intelligence. And artificial intelligence is a sector that is on fire. It's going to keep blowing up. Technology is going to get better. They're going to come out with new, more innovative approaches to that, sector of the market. So definitely a nice play to be in. Then we got ticker DBEF. This is X-Trackers Hedge Equality ETF. This one here, like everything else, was beaten down about 30% near the pandemic. Came all the way back, finished almost up 2%. This one will give you probably about a 6% growth per year, with a decent dividend of 2.34%, and a decent PE ratio as well. And this is going to track developed market entities, including in U.S. and Canada. It's hedged for currency exposures from the U.S. dollar's point of view. Then we got ticker DBEU, and this is another X-Trackers fund, and this is a Europe hedged fund. So once again, a nice exposure to a foreign market. Sorry, that's my job. This one was down about 30% during the pandemic. It did fully recover. You can expect about a 4% growth out of this one. Decent dividend of 2.35%. PE ratio is pretty good still. And this is going to track, currency hedged index companies, developed in Europe. Then we got ticker USSG. This is the X-Trackers as well. It's going to be a ESG leaders equality. It had a nice week last week, up 2.41%. Had a nice year. It was down about 30% during the pandemic. Finished up over 17%. This is a fairly new company. It just IPO'd back in March of 2019. You can expect about an 8% growth out of this company per year. Decent dividend of 1.40%. Nice PE ratio for this one as well. And this one's going to track U.S. and mid-cap stocks screened for environmental, social, and governance characteristics. So kind of the opposite of a sin stock there. Then we got ticker SNPE. This is another X-Trackers S&P 500 ESG stock. This one was up 17% of the year after bouncing back from down 30%. Excuse me. Also IPO'd about June 2019. This one will give you about 6% growth per year a 1.41% dividend, nice PE ratio, and it tracks a principal selected market cap weighted index of U.S. large cap company securities. Then we got ticker KU. This one here, I can't even pronounce that, so I won't even try. But I mean, the name really doesn't matter as long as I know the ticker and the fundamentals of the company. But anyway, this one here was started back in April with the IPO. I had a very solid year of 45% growth. This is gonna be a nice growth play, and it does pay a nice little dividend of 1.85%. PE ratio is still good with all that growth, and this is gonna attract large and mid cap developed markets, right outside of Japan. Then we got ticker CN, and this is going to be a Chinese equity ETF. So once again, a nice exposure to another market, a different sector, and a different way of providing stocks for these ETFs. It's down about 20% during the pandemic. Finished the year up 32%. On average, this one grows about 12% a year. So a decent growth. Very small dividend of 0.75. Super low PE ratio, so pretty much undervalued at the moment. And this is going to be a cap-weighted index that's exclusive to all Chinese shares, regardless of their exchange-listed location. Then we got ticker DBEZ. And this here is going to be a Eurozone hedge equality ETF. Also, during the pandemic, beaten down about 30%. Did recover for the year. It's going to give you about 6% growth per year. Dividend of 1.92. PE ratio is all right. It's not too good, but it's all right. And this is going to track stocks from the Eurozone nations, and hedges out the currency fluctuations of the euro related to the U.S. dollar. I can see I got a lot of ETFs. A lot of these are new trades for me in my portfolio. I am into the regular ETFs like VOO, ticker VOO, SPY, SPY, BND, Total Bond Market for Vanguard, and things of that nature. But I'm always trying to add new plays or swing trade plays and kind of test them out and see what they're about. Next, we got ticker NVQ. This is a AI enhanced next value ETF. Super new ETF, just started back in December. It's already up 11%. Super low dividend of 0.11. This is going to be more of a growth play as it deals with the AI, sector and the, the top value companies in the AI sector. Next, we got QRFT. And this is, I had a decent week last week as well, up about 2%. And this is another AI play. It's going to track large cap AI companies out of the U.S. So another exposure to artificial intelligence. This one here is about down 30%, like everything else during the pandemic. Finished up over 40% on the year. This thing just started back in May of 2019, but it is seeing probably on average about 11% growth per year. Dividend pretty much non-existent at a 0.05. And this is going to be an actively managed portfolio as well. It's going to track large cap companies, in the artificial intelligence sector. Then we got ticker AMOM. This is going to be another craft AI enhanced large cap momentum ETF. Just like everything else, down about 30% on the pandemic. Recovered all the way up, finished up 25% on the year. This is a fairly new IPO back in May of 2019. It's about 6% growth per year. Non-existent dividend of 0.06%. And this one here is actively managed as well. It's going to track large cap entities chosen within the aid of artificial intelligence out of the S&P 500. Then we got ticker MSOS. This here is advisory shares pure U.S. cannabis ETF. So once again, exposure to another sector. Cannabis is, getting legalized everywhere. It's a booming market, upcoming booming market. So this is going to be pure companies out of the U.S. that are in the cannabis sector. So advisory shares are going to give you their best cannabis companies, all in one stock. Maybe companies like Planet 13 based out of Vegas, Canopy Growth, Aurora Cannabis, who knows? You can check out their top share listings and find out exactly what's in there. But overall, it's going to be their top picks of the U.S. Cannabis stocks in this ETF. This one just recently started back in September of 2020. During the start of the real craze hype for this thing, finished the year up 63%. So a nice first year for them. Super low PE ratio. Doesn't really pay a dividend. It's just a 0.15%. More of a growth play here in the cannabis sector. And this is an actively managed portfolio as well. And like I said, it's going to track those top cannabis companies in the United States. Then we got ticker DWEQ. This is Advisory Shares Dorsey Wright Alpha Equal Weight Fund or Index here. This thing also was beaten down about 30% during the pandemic. Finished the year up over 11%. Not too old of an IPO. Started back in December of 2019. So it's been going on about 13 months. You can probably expect about 8% growth out of this company per year. Dividends only 0.02%. I don't even know why they pay it. But hey, I guess it's something. You can't let it drip, let it compound. And this is an actively managed fund as well. It follows a quantitative propriety model based on momentum indicators and seeks long-term capital appreciation. Then we got ticker DWUS. This here is going to be another Advisory Shares trust. So as you can see, I'm just steady switching funds, hedge managers. Some of them are actually new, hedge funds, that I haven't gotten into. But, I'm going to test them out. I'm going to research these board members and see what they're all about. This one here is more of a growth play as well. Finished the year up 37%. Down during the pandemic about 30%. So a straight bounce back. Of course, being that it started back in late December of 2019, it would have that type of year. Basically, anybody that was in the stock market, through March and after March, going to make money pretty much on anything you would have bought. This one's dividend is 0.08%, so not much of a dividend, more of a growth play. It's actively managed as well. It's going to track the funds of U.S. large cap companies that follow certain rules based on momentum strategy and seeking long-term capital appreciation. Then we got ticker DWAW. And this is another Advisory Shares Trust. This is all world cap. This is similar to the last two I just mentioned, except for it's all world instead of just U.S. companies. Again, they're down about 20% during the pandemic. This one actually finished the year up 51%. Fairly new IPO, same time frame in December. Once again, not very much of a dividend at 0.28%. And like I said, it's gonna follow. It's looking for capital appreciation and momentum. From a world market cap. Then we got ticker CWS. This is a focused equality ETF. This one here, during the pandemic, was about 30%, like everything else. Finished the year up 18%. On average, you can expect about 25% growth per year on this play. Of course, with all that growth, you're not going to get a very big dividend. Only 0.27%. This one's got a PE ratio of 28.52, so very nice there. This is an active long-term capital appreciation and outperforming index. This actually outperforms the S&P 500, by holding like a focus group of listed U.S. stocks using proprietary models that they come up with. So very nice there. Then you got ticker VEGA. Another Advisory Shares. As you can see, it had a positive week last week, up almost 2%. And this is a buy right global ETF. So I would probably say for this one, it's going to be a nice play just because it's a safe place to play, to put your money. Doesn't pay very much dividend, but you are going to see like a steady nice growth from this ETF. I would say probably about 9% a year. Nothing too bad. This one was also affected by the pandemic, the same as the other one, about 20-30%. but still finished the year up 8%. Again, this is actively managed. It aims for consistent returns, in part by writing calls options on its underlying securities. Long puts are used to hedge downside risk. So it's basically having somebody doing options and puts for you that are professionals, using, I guess, kind of using your money. Then we got ticker DUDE. This is a new hedge fund for me as well. Momentum ETF in the artificial intelligence sector. This one just started, last month. It's already up 6%. Doesn't pay a dividend at all. There's not a lot of information, as far as technicals related to this company because it's so new. But it's a fund of funds that is passively managed to track an index that shifts strategies during times of a bull and bear markets. The fund uses algorithm indicators that uses the momentum and other technical factors to assess its market risk. So when we're in a bull market and a bear market, this thing's gonna be actively managed to suit whatever positions that it needs to have in that ETF. So definitely something I'm gonna give a shot and see what it's all about. It's pretty interesting. I like the fundamentals of that thing. Then we got ticker PTH, Power Shares, Healthcare Momentum ETF. Down about 20% during the pandemic. Of course, healthcare sector is booming, up 85% on the year. This one grows pretty well, about 40% a year. Very low dividend of 0.11%. Super undervalued right now, even with all that growth. And this is an index of U.S. healthcare firms selected by price momentum. So they're obviously doing a good job, with their strategy of the way they're selecting healthcare stocks based off of momentum. Then you got a DWA Momentum ETF from Power Shares. Of course, about 30% down on the pandemic. Finished the year up over 30%. On average, this one's going to grow about 20% a year. So it's going to also give you some nice growth. Super low dividend payout of 0.11. And this one is going to track the top 100 U.S. listed large cap and mid cap companies selected and weighted by relative stock performances. Then we got ticker PIZ. This one here is a Power Shares fund, and it's dealing with the developed markets. Had an okay week last week. Really didn't move very much, but once again, it's better than nothing. Then we got JMOM, ticker JMOM. This is the Momentum Factor ETF. Once again, decent week last week. Then we got ticker PTF. This is another Power Shares. I'm kind of going to breeze through these because this video is getting pretty long and a lot of these are very similar. This is a technology momentum portfolio. So when they're momentum portfolios, they're going to be, focused on that momentum of whatever sector. So this was technology, right? This one also, these momentum plays aren't going to pay very much dividends. This one's 0.09%. They're all beaten down about 30% over the year. What you want to look for is how much they grew afterwards. Like this one was up 80%, and you want to look at their, their average annual gains per year. This one does about 25% gains per year, and it's U.S. tech firms selected and weighted by price momentum, all in that ETF. Then you got ticker IMTM. This here is another iShares momentum play, factor ETF. Same as the other factor ETFs, just provided by a different hedge manager. Still beating down about the same 30%. Bounce back up about 24%. It's going to give you a nice about 11% growth. This one actually pays a little bit more of a dividend of 0.95%. And it's going to track large and mid-cap stocks from developed countries. This fund basically selects stocks by momentum and weighs stocks by market cap and momentum. Then we got ticker DWAS. This here is another Power Shares small cap momentum play. And this one during the pandemic was down about 40%, recovered, finished up 40%. This one on average is going to finish about, grow about 20% per year. A very small dividend of 0.20%. This one's super undervalued. Great PE ratio here. And this is going to be an index of 200 small cap securities with the best relative strength indicators, and they're basically determined by Dorsey Wright's methodology. Couldn't even get that out. Then we got SNUG. I guess that'd be Snug. This is an Alpha Architect ETF trust from Technical Growth and Income. So kind of a mouthful there. Pause. I just wanted to say that. This one here pays a decent dividend of 0.91%. Fairly new company, started back in February. Of course, it went right down about 20%. Started pandemic, finished the year up above, up 11%. So a nice little bounce back for them. Like I said, a small dividend payer. It's gonna be more of a growth play, and it tracks, it technically tracks or allocates 30 to 70 global bonds, U.S. bonds. And it also has a market risk indicator, to shift to more conservative allocation when risk in the U.S. Entities appear evaluated. So a nice managed fund there. Then we got ticker SPLV. This one here is a power showers, low volatility. The best companies out of the SP 500 with low volatility are going to be here in this play. It was down about 20-30% like everything else in the pandemic. You'll probably see about 2 to 3% growth in this company next year. It's got a nice PE ratio of 25.11, nice dividend yield of 2.12%. Like I said, it's going to attract the out of the S&P 500 the best companies with the lowest volatility rating. Then we got ticker KBWB, power shares, KBW bank portfolio play. Banks are on a major comeback this year with the share buybacks and things of that such. Vaccines coming out, people getting to work, people are going to pay their loans back, people are going to pay rent. The interest rate's going to go back up, so banks are a bounce back play for this year. This thing was down, of course, about 50% during the pandemic because of the non-payment systems and the stress test and all those things. I expect about 5 to 6 growth out of this ETF next year. And it does pay a nice dividend of 2.4%. Of course, a super low PE ratio. It's super undervalued. And it's going to track the top companies in the U.S. in the banking sector that have the biggest market caps. Then we got another play here, SPHD. This is something I hold long term. This is a one that I'm very familiar with. I'm up 11.47% in my position, while also collecting a very good dividend of 4.96%. And this is basically power shares, high dividend yield, low ETF. So it's going to track companies low volatility with that high dividend payout. I think for next year, this year in 2021, I think it's going to actually get a nice growth of about 12%. So I think it's going to do very well this year. Like I said, I'm already up 11.47%, and I'm collecting that nice dividend yield of 4.78%. So SPHD is a great ETF that I've been into for a while, and that I always swing trade. And like I said, it tracks the best dividend yield weighted index, comprising of at least 50 least volatile names chosen from a short list, of the S&P's 75 highest dividend yielding securities. Next, we have ticker PCY. This is another power shares fund. Didn't have a very good last week, but overall in the year, I think this year it's going to come back about 3 to 4% as it's still recovering from the pandemic. And this one also pays a nice dividend of 4.51%. The the expectations of the EPS are looking good. And this is an index of U.S. dollar dominated debt emerging markets with at least 3 years in maturity. So very nice, safe play. You're going to get some nice growth, nice dividend. And that's the year to own this one. So that is about 40 to 50 ETFs that I have selected for today, for this year. I appreciate you guys tuning in once again. If you like the video, hit the like button, subscribe, all that good stuff. I got to get out of here, and I got to make about 26 trades, so I have to do that video as well and do it for all my other social medias, and pay attention to what my job is trying to tell me. So I appreciate y'all tuning in once again, and I'll let y'all get back to it.